welcome again, everyone. It's Tuesday morning, and excited to be here to share a couple things about today's real estate market, and also what Justin has been seeing. And I'm gonna introduce Justin here in a second, but also about self-directing and how self-directing IRAs can and should be applied in your lives, hopefully in your business lives and financial retirement lives as well. And so, that being said, as normal. Our disclosure, we are not financial advisors, not attorneys, not CPAs. You should go to those professionals to seek guidance. If you love any of our opinions or thoughts, feel free to go get another opinion to find out, make sure that your counsel agrees or disagrees. That being said, I have done this for over 20 years. I've been very much in this retirement real estate space since I was a kid, since I was 23, and it is near and dear to my heart. It has changed my life. And so uh, I've shared this maybe only a couple times, maybe once or twice in the last 2 years we've been doing webinars. So I'll preface this again as we kind of get into today's subject. Is I started in this space, in real estate space, by someone first lending to me part of their IRA, in a self-directed IRA, to be my partner to flip my first condo when I was 23 years old. I share that with you because from my early ages of my career, of my real estate career, I dove straight into this subject. And most people don't dive into something like IRAs or self-directing until they're much older, because it doesn't sound sexy. It's not near as fun as what Justin does for a living. And so we're going to talk about how those two worlds kind of collide. And so one other thing I'll say, and feel free in the chat, and or any of the questions, you can throw in the question down below. Claudia is here. Claudia is our rock and foundation at Horizon Trust Company for all new business, all new relationships. And so most likely, if you are working with us, you have either spoken to her or someone on her team, and she's going to help us answer some questions along the way as well. We're going to definitely leave plenty of time for questions and answers for both Justin and I. But that's kind of the housekeeping stuff. Claudia is going to be here and make sure we don't miss anything. And also, we'll once in a while make sure, between her and Alicia, will also make sure that our contact information is there for you to reach out to myself and or Justin or Claudia to find out more. So all that being said, welcome everybody. Welcome Claudia. Welcome all those that are listening all over, from East Coast to West Coast. I saw people all the way from New York and Florida, all the way back out here to California and Las Vegas. Thank you for listening in today, and I'm excited to share a couple things with you. That being said, let me, without further ado, introduce Mr. Justin Colby. Justin has been a longtime friend of mine. And it's great to see you. I was actually with you this last weekend, and great to see Justin. He is and continues to teach and coach literally thousands of individuals from different stages and different platforms on how to really get into this real estate game. And real estate, I know, is a big, it's a wide net when I say real estate, but Justin has taught so many individuals how to look for real estate opportunities, how to purchase, how to get creative, how to get financing. And so I wanted to have him on here and just kind of talk about what's going on today. And so before we dive into what Justin's up to and how IRAs are related to this whole world, Justin, welcome, and thanks for tuning in today.
Yeah, I'm excited to be here and pour into your tribe here. This is we literally talked yesterday about this, you, me, and Claudia. Like, this is a passion project for me to help people also understand how your world, my world, can literally marry each other in such a seamless way. And people just aren't educated on it. They don't really get it. They kind of know there could be something that you could maybe do if it's structured right. And so I'm like passionate now to help people take what you have in trust companies and in retirement accounts, and how do you actually marry that with real estate? Because I don't think anything. Okay, I'm not going to use that word again. Everyone wants to be in real estate. Everybody. I have not yet met one person who's like, oh, I don't want to own my own home, or I don't want to buy a rental, or I don't want to own an apartment or a storage facility. or I don't want to buy some land someday. I've never met one person that doesn't say, I don't want to do this. Some of you might already be doing it, but I've become increasingly passionate about helping educate. How do we make sure you understand the bridge of like what you have and then how you can best utilize it, right, for the things that you want, right? And so I'm excited to be here today and happy to do any level of Q&A that you guys want. If Greg, you're going to Q&A me, that's fine, or if they want to, or if you want me to go off rip, I'll do whatever we need to do so you guys can have the want. The want part is big for me, right? Is Greg and I really, I mean, Greg's made me an incredibly special one of one hat talking about like because we can live the life that we want to live. Real estate for me has been that vehicle that has allowed me to live the life. And so however I can help pour into you guys, I'm going to do it here today.
Well, let's jump into that for a minute, Justin. So I have noticed in the last, I don't know, I feel like this year, the last 3 or 4 months, you more than ever that I've noticed is you have been speaking on lots of different masterminds, lots of different stages in front of hundreds, if not thousands, of individuals. Uh, just me from an outsider. For those who don't know who Justin Colby is, although it sounds like someone might have went to high school with you, which is interesting. Um, but for all the rest of
Gene.
you did not go to high school with Justin Colby.
Yeah. That's
Um,
great.
well, just why are you in the last 4 months? Why have people been calling you and asking you to speak on different events and masterminds? What has been your message and what have you been sharing? Because I think that's a great place to start. Just because I noticed you've been out and about a lot.
Yeah. Well, so the reason why at this point in my career, and you guys have to, I'll give you a very brief background so you at least know my history here. I've done this very specific thing, which is either wholesaling, fix and flipping, or buying rentals for the last 2 decades. And so, Gene, since you went to high school with me, you know when we graduated, right? I can do this for 2 decades, which means I'm 43 years old. And basically, since the time I graduated college, this has been my vehicle. This has been my industry. And over the last several years, I've really been asked to really echo a message and give the story of why this is important. And the reason is because everyone wants to be in real estate. They don't know how. But what the secret sauce that you actually were the impetus of how I understood this. I mean, a decade ago, you said, Justin, you're doing great stuff, but imagine if you knew a little bit more of the secret sauce, and then you taught me everything that hopefully I can continue to help you teach others, which is this, is you should be able to create income in real estate, right? This is the fun. This is the TV shows, the fix and flip shows. But you should also be able to create wealth through your retirement account. Your retirement account, in my opinion, should never be sitting there. Like I personally have a retirement account at Horizon Trust. I also have a retirement account. I don't let my money just sit. It's investing. It's always investing. Because to me, I mean, the fact that I can go make money, and let's just say I lend the money on a project so and so does, Gene does, and Gene gives me X agreement of a return on that, it goes back into my retirement account tax free. Tax free. And it sits there and it grows and it multiplies over and over and over again. And so, what I like to try to echo to people is if you have a desire to be in real estate is very multifaceted, right? I own apartments, I own storage facilities, I own single family homes. I do transactional real estate where I'll still wholesale and fix and flip to make income. That's why I don't need, if I lend my retirement money out, I don't need the income from it. I create income from the activity of fix and flipping and wholesaling, but then you can actually go buy land, buy apartments, and kind of create that other side of your life through things um, that there's a vehicle that you guys already have here at Horizon Trust, and it can create equity. I mean, one of the things I could talk about this forever, Greg. So you're teeing me off, and I'm just gonna go like you can own real estate in your retirement account.
Now, 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 but so I actually love that you're sharing my message, which is great because you've been living it and doing it. But in fact, you've bought.
You only taught me this for over a decade.
He's one of the first people that convinced me to buy Bitcoin a long time ago with his IRA too. And so that bought it a little later than you, unfortunately. That being said, the the last few months you've been talking a lot about which subject the most because I feel like since Trump's been in and the politics have changed, you've been doing a lot more speaking, and I don't know if that's just by design, but tell me specifically what is the message today in the last 3 months that you've been talking about as you go out and about? What have you been sharing?
I mean, wealth creation. At the end of the day, it's very cool to be able to create a lot of income, and all of us want more of it. I want more, and Claudia and Greg you guys all want more income. I don't think that'll ever stop because income creates a lifestyle. But I really want to create wealth. I want the longevity of wealth. Here's why. If you have wealth, specifically in my vertical real estate creates three levels, right? That I want you guys to understand. It can create the income. So I own an apartment, the rents pay income. That is income to me. Now I can take it or not take it and all that, but we'll put that aside. But that is the income side. The other side is bankability. I create equity in that. I then can go to a bank and say, against this equity, I want to borrow a loan, get a HELOC, recapitalize the equity that's in there. The other side is further wealth creation. I have an apartment. I say, hey, I don't want to recapitalize. I just want to strip my equity so I can take that money. I want to take $2 million of this equity I have, and I want to go buy another apartment. And I continue to create more wealth and more wealth and more wealth. And as long as you don't need the money, which is why we have retirement accounts, because usually you want to keep that money active. My opinion, my own opinion, no one else's. I'm not a financial advisor. I wouldn't want money to be sitting in a retirement account. I saw someone say they have an SDIRA. I do too, right? I don't want it to sit because then it's stagnant. It's not creating wealth. You're not going anywhere, right? Like, I don't know all the numbers, but if it's just sitting there, it's not doing what it should be doing, right? Which is growing. And what I would want to impress upon all of you here is find verticals, find ways to take the asset you have, which is this retirement account, and learn from Greg. Oh, like every call that he does, be on it. Because he taught me over a decade ago on how to do what I do in the real estate sector. And it's very easy. There are laws and rules that you adhere to. Okay, very much so. But when you adhere to those laws and rules, it is a very easy way to increase your wealth over time. I sat down with Greg, I don't know, was that 3 or 4 years ago? I don't know, 3 years ago, 4 years ago. And I just said, like, I'm at a place where I now want to create a legacy of sorts. I know it's a generic word, I just don't know what else to use. And I want that to be big. I want to have my net worth. Like, I'm going to have a B behind my name, right? Like, that's where I'm going. And by the way, if I get halfway there, that's a whole lot of money. And if I even get half of a halfway there, that's a whole lot of money, right? And so to me, I want all of you to recognize you have the ability to create your life, right? And so if you have that ability and you have an asset, and all of you guys have something that not a lot of people in this world have. And Greg, you probably know the numbers, but not a lot of people have money set aside, money in a retirement account. A lot of people live hand to mouth. Like they don't have access to this. If you do, I would encourage you to be able to look at that and say, okay, there's ways that I can grow that wealth, right? And so that's what I've been talking a lot about is being able to create your own life, right? And by the way, if you did use a retirement account to create income and just wanted more income, that's okay too. You're just going to get taxed on it, right? But that's okay. So you use your retirement account to do this real estate deal. This real estate deal makes you 100 grand. You're like, man, I'd love to take the family on vacations and I want to go buy this thing for my wife and I could use a new car. And you want that 100 grand of income, then take it. It just gets taxed, right? And so it's just such a cool tool. I can't speak highly enough of the tool of retirement accounts. And by the way, it is not the sexiest conversation. Greg and I, a lot of times, will be speaking on stage together. And probably the first thing he does is say, hey, I'm going to talk about the least sexiest, but most sexiest thing you guys could talk about, right? People always laugh. And then he has their attention because if you think about retirement accounts, they aren't sexy until you know how to use retirement accounts. And they can be probably the most sexy conversation vehicle that there is out there because of everything that Greg knows how to do with that for over, 2 decades himself. He did this one thing, right? And so What else? I hope I answered that question. I kind of went off on a wealth tangent, but
Yeah, no, well let's I want to dive a little bit into your specific world. So the thing that people ask me often when it comes to real estate is in particular right now. We've all seen what's going on in, the political stock market, but let's just talk about for you in real estate.
yeah,
What would you tell someone today as they're looking at today's real estate market and what's going on? Is now the right time to buy? What should they be looking at buying? Give us some specifics to real estate right now, taking the IRA kind of equation out of it because I
sure.
think it applies regardless. So just how do you answer that? What are you seeing, and what are your clients and your students doing as well?
Yeah, I think, what I try to impress upon my world, and like you mentioned, I've been doing this for over a decade, teaching thousands of people how to win at real estate. But I like assets that have some safety nets around them, right? I don't want to take massively big swings. I like, if we're going to be, let's just talk about single family assets. I like what's called the Burr model, right? Buy it, rehab it, rent it, refinance. I've done that a lot. More often than not, I get very close to getting all of my money back out. There are times where the appraisal doesn't favor us. Okay. So sometimes there's a couple of dollars stuck in the property.
Has that changed a lot in the last few months, or has that still been a good method the last since let's say February till now? Is that Bird model working? And if it is there particular just because a lot of our clients a lot of time will say, well, that sounds cool. Can't do it in California, which typically you can't do anything in California, nor should you. But like so where are you doing? Are you currently doing the burn model? And if so, can you share what a couple of the states or cities that you're doing it in, just to give
Yeah.
some specifics?
Yeah, so I like the Sunbelt states, right? So the Sunbelt states to me are North Carolina, South Carolina, Florida, Alabama, Georgia, Texas, Tennessee, Oklahoma, right? That's kind of the way I look at it. The reason why is what I just said. I have a safety net to some extent. I don't usually play much higher than 300 grand in the single family space. The reason being is you could either fix and flip this property or you can keep it as a rental. You're never gonna like, how do I say it this way? If you buy a $200,000 home, no one ever went bankrupt buying a $200,000 home, right? You can rent it. It may not be the most profitable rental, but you protect the downside. The thing that real estate offers is if you look at the history of real estate and the data for over 40 years, it has only gone in one direction. Only. Now, some of you, oh, what happened about 2008, 2009? Where are the values today? Right? Those little blips, like we could even make the argument right now, the blip, right? There is still a shortage of inventory, still to this very moment. You know what? One thing all of us need besides air, a place to live. I mean, food. Food would be nice. But if everyone has to live somewhere, they are either going to own the asset or they're going to rent the asset. Okay. Well, in that case, like own the asset that they have to own or they have to be in. Okay. I don't want to get too far in the advanced area, but like you can do both, by the way. You can own the asset and essentially just become the bank afterwards and sell the asset off. And now you just own the paper. It's a little advanced. I don't want to go too far advanced, but like you could do seller finance sales. You buy it, you remodel it, you sell it to the tenant because they don't want to just rent. You sell it off, you carry the loan, right? And now you're the bank and you don't have to deal with all the maintenance of the home. And so
Justin,
in these,
somebody's asking how long would you keep the property
Which in which case scenario?
Jorge, great Jorge
to be
or
able to
George,
use the BRR model?
I the rule of thumb, I would go 5 years,
Five
right? And the
years?
reason being is 5 years, most lenders, the DSCR loans and long-term loans, they usually have a step down. And what that means is if you buy it and you refinance into a DSCR and you sell after year one, they basically are going to give you a 4 year step down that you're going to have to sell of this. You're going to have to pay them the 4 years of interest that you were going to owe. Okay. So as a rule of thumb, I would try to keep it 5 years or more. If you are like me, I don't really want to ever sell. If I am going to sell, I would like to sell and move up. Meaning, I might, we just took a lender and wrapped 5 of our rentals into one loan, right? One loan has the loan on 5. So if I were going to liquidate that, I would take I would take the revenue from that and buy 10 more, right? So I don't necessarily want to sell for selling's sake. I want to continue to level up, right? Because ultimately I want hundreds, if not thousands of rentals, because that's when real estate gets really sexy. Because you have what's called economies of scale. If I have 1,000 single family homes that are $200,000 each, do that math. Do you guys know the number, right? And then economies of scale, if you have 1,000 rentals and 100 of them go vacant overnight, we have 900 other homes that are paying for those vacancies. Make sense? Um, and so I would like 5 years or more is the right angle. And by the way, keep it forever, right? Because, Jorge or George, forgive me, one or the other. I would also suggest if you own it for 10 years and you buy down a bunch of the loan by paying the mortgage, right? So 10 years, you gain more equity. 10 years from now, that home for sure is worth more than it is today. So now you have even more equity. Guess what you get to go do? Refinance it again. I'm going to make up a number, take the 80 grand that the bank just gave you on a cash out refi, made it up. I'm going to go buy another rental and I'm going to keep that same home for another 5 or 10 years. And now I have 2 rentals. And then you go do that again every 3 to 5 years. You go and just go to the banks. Hey, give me another 80 grand against this equity. Hey, give me another 80 grand against these 2 homes. Give me another, 160 grand against these 3 homes. And then all of a sudden, you rinse and repeat this model long enough over runway. And so this goes back a little bit to your question. I want people to buy themselves runway. I think most of us, especially if you are looking for a better future and kind of the bigger wins, most people don't give themselves enough runway to experience the better win, right? The going gets tough, things don't go well, new president, new interest rates, new things. They kind of get a little squirrely. And they don't say, okay, hold on, let me get some runway to figure out the best moves, to figure out how to win better, right? And so if you do that in real estate, one of the biggest mistakes, the very biggest mistake I've ever made, the very biggest mistake I ever made is I didn't buy rentals early enough. I didn't. Okay. I did everything transactionally. I enjoyed the money too much. I went to Vegas all the time. So I spent said money. But then, as Greg told me when I started having babies, you start to get real serious about money, right? You don't flippantly spend it. And I did. And I just started going buying rentals. And I said, I've done a lot of deals, thousands. And buying rentals is more of what I try to focus on. And it's because I want to give myself runway to get to 1,000 doors. Right. And so if I keep refinancing out of the door I already have and strip the equity and go buy another home, I'm not telling you guys to over leverage assets. I'm just saying in 5 years, your home for sure is going to be worth more than it is today. The loan may or may not be better interest rates, doesn't really matter. You have money stuck in the house, right? So it's a funny thing, Greg, because I'm all about real estate. My wife had to pull my hair, see how much hair I have, to make me buy my home in Miami. I'm actually, as a real estate person, a real estate expert, I'm actually not the biggest advocate of owning your own home. Now, this might turn some of you guys off, but it's because I think like an investor. So if you look at your home and leverage it in a way that you could look at it as an investment, then it has a lot of chances to be a liability. How do I know that? Because last year I had to replace my $40,000 roof. So my accountant says, great decision, Justin. You're going to get tax write-offs by owning your home. And I say, oh, that sounds nice. Okay, great. Well, I'll tell you, those tax write-offs from my interest I'm like, is he going to replace this $40,000 roof for me? Maybe not. So I think if you think like Greg, if you think like me, owning a home could be a big asset because you can actually have tax write-offs within the home. Like this office I'm sitting in my home right now is a tax write-off, right? And so I like using real estate as a true investment vehicle, even my own home, because I have about $1 million equity in my home. I literally just went to the bank. last week and say, hey, how big of a HELOC can I get? Why? It's just sitting, it's stuck in this home. It's literally sitting in it. All this money. I have $1 million or so. Well, how can I work that? How can I grab that money? I know how to flip homes, which means I know how to flip money. What can I do with that? Sorry, I'm going on a tangent, so I want to make sure I keep up with the questions and where you want the conversation to go.
This was good. I've got so many. I want to unpack some of those things that you shared. So a couple things that I want to share. Just listening to Justin and seeing a couple of the comments there. My experience and what gave me comfort listening to you is answering the where should somebody be investing, and that is really up to you. And as far as if it should be wholesaling, it should be lending, if it should be buying and holding. When you speak about certain things, for me personally, I get excited about some of those. And other things I cringe, not because they're bad, but because I have no interest. When you talk about wholesaling, it doesn't get me excited. When you talk about buying and holding and waiting a few years, like for me personally, and so I share that with everybody because as you hear different guests, and in particular Justin today, talk about different subjects in real estate, which he's participated in D, all the above, it's an opportunity for you to kind of hear what is most important that makes you sleep good at night. And some things that someone shares with me do not make me sleep good at night. For example, when Justin talks about sitting equity in your home, I look at my home very much like Justin talked about it. It is my home. And I know it's an investment, but I don't make investment decisions based upon my home. I'm going to overpay for it. I'm going to put too much money into it, but it's the place where I can be with my family and I can get good sleep at night and my kids will come back to me. To me, that's my investment when it comes to my personal home. And I don't look at it as a cash cow to go. And now if there's a benefit, do I get to sell it for a profit someday or whatever happens there? Cool. But I wanted to just mention that because I saw a comment. I think Laura, you're from California, and I'm in California as well, and then also in Las Vegas. And I can't remember the last time I've done a deal in California. Of course, there's people all around us making money in California, but typically there's different segments in a real estate transaction where people make money. In California, in particular, a lot of the money can be made just in waiting through the process to get something approved and permitted and zoned correctly, which builders are not willing to wait on. So there's an opportunity for people in California that want to buy the land and get it zoned and approved the right for a particular, if it's asset class, and then sell it to a developer. Developers don't have patient money. Developers want to buy an asset that's approved with certain zoning. And so I share that with you. And Laura, I think it was your name I saw in there. I, in particular, find individuals, people who are investing in asset classes that I like and understand, in places that I like and understand. It's taken me, a long time. I think someone mentioned something about scaling. I didn't read the whole comment, but it does take time. And it took me a while to find the right individuals that I wanted to partner with my money because I did not want to do all the legwork. After doing it for 10 years, I decided I no longer wanted to find the deals. And so I wanted to find the right manager or right partner or sponsor that was going to go find the assets, oversee the asset to execution until it sells or till it's renovated or until we burr the money back out. Scaling takes time. And in my world, I've learned the hard way that anything that's supposed to happen quick typically has issues. Doesn't happen quick, has more problems. And so I've learned to start now, even today. I get involved every year in new asset classes. When I say new asset classes, new assets. I try to stay narrow-minded on my assets that I invest my money in. But that being said, I want to make sure that hopefully everyone's getting what they want as they listen to Justin here. That if anything, when someone's talking about a particular subject or methodology, if something that I shared with makes you feel good, that's probably a good sign of, okay, this resonates with me. This is the type of investing that I want to look into. And same with what Justin's brought up a couple different subjects. And I like that because you get to hear a breadth, a decent amount of different options that you can look into, spend some time and energy in. And then for me, I use both IRA and non-IRA money in different asset classes based upon what's best for me. And that's the point of a lot of these webinars, is for you to hear what people are doing, why they're doing it. The Burr model is awesome. I mean, on a big scale, like him or not, our president, and recently, I guess most of America doesn't, which it is what it is. This is not a political station. One thing that I'll say is that he's amassed a lot of his wealth by buying these big assets and doing his own Burr model, right? He'll go in and then he'll borrow 5, 10, 20, $50 million because he's got this equity. He borrows it. And when you pull out that equity, how much in taxes do you pay on a loan against an asset on your equity? Nothing. So now he's got that. And in this case, Justin gave a good example, or $80,000, and you go out and rinse and repeat. Now, I don't want to dive into, and nor do I want to open up the chat box and what Jump did or did not do with monies that he takes out from different asset classes. The model still works. Avoiding some taxes still work. Now, transitioning it into the IRA world, for those that are new, sorry that we didn't really dive much too deep into it, but we're not going to too much today either. Claudia is going to put in here in the chat, and also a link for those of you interested in understanding and diving deeper into how your IRA or your old 401k can be invested and used and utilized into real estate. You can schedule an appointment with us. That's what we do on a daily basis. We teach dozens of people every single day how they can use their old retirement account or old 401k, work with a company like ours to then have access, unlock those monies to invest in a real estate transaction. I would say 90% of our clients are investing in something passively with their IRA. It's not very active, meaning they're not the ones that are picking too much of making the decisions on the asset. Typically, our IRA investors are partnering in a fund or lending their money to an individual, to a Justin Colby or someone like him, or that's hands-on the real estate transaction. And so you get to pick and choose as a self-directed IRA investor. This is something that most people do not let you do. So this has been around for over 40 years. The self-directed IRA has been around since the 70s. We're very good at teaching people how to do that. We have over $1 billion in assets at Horizon Trust, over almost 8,000 clients. And we focus on teaching people the concept, but not where they're going to actually invest it. And that's one of the reasons why we have the investment corner. We have guests on, we talk about them, so you then can go out and do your own due diligence. I would say most of our clients, and probably 70% of those listening today, you were introduced to us through somebody else that had a fund, had a real estate opportunity, had a business of some sort, and they maybe referred you to us. And we're proud of that. We probably get the most referrals and testimonials because we do take a hands-off approach, not on approach, of making sure that we help you to invest in what you know, like, and understand. So for those of you that were wanting to know more specifically about self-directing, we'll schedule an appointment with us. Today, we want to dive a little bit deeper into what Justin Colby's seeing for his students and his clients in the real estate world. For those that wanted to go deep into the self-directed world, that's going to be on our next webinar or a one-on-one free consultation. I know many of our clients of ours, and we appreciate that. So that was my commercial break. I'll stop there. And before we go on here, Claudia, keep us on track here. Should we jump into some of the questions and answers? Because I feel like there's a lot of them. Kind of that will help us lead this conversation to where we're going here next.
Yeah, absolutely. Let's go ahead and do some questions. We had some really good ones at the beginning that I wanted to go ahead and read out to you guys. One of them was, the tides seem to have changed a bit for real estate and presented challenges in 2025 that weren't there in 2024. How are you dealing with these changes, and what would you do for the rest of this year? I thought that was a great question. It was at the beginning of the webinar, and I think both of you guys can go ahead and put your twist on it and answer it for them.
Yeah. So Greg, do you want to lead off? You want me to?
Go ahead. I've got my opinion. You go first.
Yeah, so I think kind of said earlier, like I don't necessarily want to go for big swings. I want to protect my downside by being pretty safe in the real estate space, right? And so for us in the single family home space, we like to be under that $300,000 threshold. Now, if you're talking specific about interest rates, I'm not overly concerned about interest rates. I know to some people that is a big topic, like, oh my God, 7% interest rates, things of that nature. I get it. But if you like just historically look at the interest rates and you look at data, you'll realize like it's kind of some level, like I think over 40 years, we average out around 6%. Over 40 years of data, we average around six. You might want to double check. I think it's like 6 point something. So if you get a 7% interest rate, like historically speaking, it's kind of marginal to say the least. Like you're not really winning or losing. People like to make, I think all of us got incredibly spoiled of what happened during COVID. And unfortunately, this is all my opinion, I believe it really changed the psychology for most people. And it's unfortunate because I think people lost sight of reality, right? Where all of a sudden we have 2.5, 3% interest rates. That's literally historic, never to be seen again, in my opinion. And if it does come around again, it's going to be wild. It's going to be another really dramatic scenario. But I think historically speaking, if you're in that around sixes, because for those of you, and I was just a kid in the 80s, my grandfather developed several homes in the 80s. And, he always reminds me of that his loans were like 18%, not hard money loans from banks.
Yeah.
18, 19, 20%. That was the normal interest rate. And unfortunately, or fortunately, we don't live in that area anymore. That would make things a lot more difficult. But that was their reality. That was all homeowners buying homes reality, 16, 17, 18, 19, 20% interest rates to buy a home, not an investment home, your home. And so then the other extreme was COVID, right? 2.5%. My buddy got a 2.4% interest rate. Insanity, right? Just not reality. And so now that we're living in this around 6 to 7%, I think it doesn't really matter if you stick to the data and you stick to a good, safe investment, right? Is you buy a home for somewhere under 300,000. It may not be a cash cow for cash flow in the investment space, but look at the value of homes over the 40 years. I mean, think about when you bought your first home and what that home would be worth now. I just did this, ironically enough. My mom bought the home I originally lived in for something like $248,000 because I looked it up on tax records. It is now a $900,000 home. Okay. Right. And so, like, historically speaking, it's just always a win if you take Greg's point of view and my point of view of giving yourself runway. So I don't overly focus on interest rates. If you're looking to buy your own home, the real key component is what options do you have? There's not a lot of options to buy homes out there right now. There's just not. And so then it just goes back to basic economics, supply and demand. And so I don't want to overpay, right? I like if there's a bidding war on a home because it's in the right neighborhood and the right, like if you win that bidding war, you are by far overpaying. And so as an investor, I don't want to do that. And so I'm not overly like bearish on real estate. In fact, I'm pretty bullish. Why? Because I think the question in and of itself speaks to the bearish mentality people have right now with everything going on. They're withdrawn, they're pulled back. They're like, I don't know what the hell this president's gonna do. He's a lightning bolt. We don't know what's gonna happen with the interest rates. We don't know what's gonna happen in the economy. I get that. But I'm in the real estate space. There's only one direction it has ever gone. So
Uh,
that's
yeah,
my answer.
yeah, I like it. Look, I would add something. So my again, my personal opinion, because this look, if we all knew perfectly, we'd be adjusting all of our funds appropriately. But I am in a mode of when there's a great opportunity, when the debt can cover, when I'm sorry, the income can cover the debt on the mortgage today, then I'm a buyer. That being said, do I think there's going to be some great opportunities coming in the third quarter of this year? My personal opinion is that if you are waiting for and you only have X amount of dollars that you can spend towards something, I do think that because of this bear mentality that Justin's talking about, people are getting scared. And when people get scared, the more people that get scared, and as the market changes, right? The stock market, the politics are changing, wars, etc., there's opportunity. And I anticipate in the next 6 months that
So when I click,
I don't know what happened there, but I see in about 6 months, I anticipate better opportunities than today. And so I see it, I feel it. And so if you're waiting for something to get, a little bit better opportunity or better offer on something, I think because of the market and the bear mentality people have, there'll be more opportunity here come third and fourth quarter. So that's my opinion. But coupled with if you have sitting money and there's something that just can cover its debt, and maybe a little bit better, you're not going to go wrong, which is Justin's point. And that's what I'm seeing. So find your asset class, whatever that may be, find the demographic, find the right interest or right terms. And that's the other thing I'll say is, and Justin mentioned this, sometimes it's the terms that make the deal great, not the price, right? I saw a few of you rattle off your interest rates. By the way, congratulations. You got locked in at some great twos. If you can get a deal, right, that has the right terms, it's worth more money. You can pay more. And vice versa. If you're paying a 7% or 9% rate for some reason, which I get, you might have to borrow that. Well, then you just need the right price. So you might have to get that asset for a much lesser price because of so terms can trigger what kind of price. So anyways, let's go on to the next question. I think we hammered that one long enough. What do you got, Claudia?
Yeah, so I have somebody asking if you live in California and you have $900,000 in equity in your primary residence and you are single, but you have a 2.8 interest rate and don't want to refinance, would you recommend doing a HELOC and buying another property?
Again, remember, consult your own advisors.
Yeah.
This is going to be a very personal decision. So for me to answer that, I would want to, and you don't need to share this with us, by the way, but there's a couple other factors in there. What does your retirement account look like? What do your other investments look like? What else do you have? So if this is your only asset with your only money in it, basically, is that equity? Then I would probably recommend getting a HELOC and using some of that money when you find an opportunity that obviously more than pays the debt to borrow that money. I wouldn't borrow all of it either. If you have other assets, other retirement accounts, I'm not a big on your home. I'm a more proponent, pay off your home. I know it goes against all of the world, what they say, but I like the mentality of trying to have less debt on your home, but as long as you have other, and the reason, oh, by the way, I hate it when people say what I'm saying right now. The reason why I say that today is because I have other assets now. My accounts have other monies, so it's easy for me to say that. If you don't have other retirement accounts and other investments that build up to something that's a decent size, then you need to leverage some of that equity because it's just sitting there and you need to build more. How much, again, is going to come back to how much, how much risk you should take, what your age is, and things like that. So sorry, it's a little bit, there's two answers to that question, but I think I answered it pretty well.
Yeah. And somebody's asking, how do you leverage the equity if the real estate investment is in your SDIRA?
If the real estate, if you have an asset that's owned by your self-directed IRA, you can borrow against that asset with a non-recourse loan, which basically means that you personally cannot borrow the money, nor is your asset a guarantor of that loan. But by the way, there's several banks that we have relationships with that our clients use. Tim Harridge, a good friend of Justin and I's, has a lending company that lends on it as well. But you
Tim
can
Harris, is that what you said?
no, Tim
Oh,
Harridge.
oh,
In fact, he's on with us in June. He's going to be on this
oh,
webinar, and so there's companies that like to lend. Now, just so you know, because there's no personal guarantee, no personal liability, and your IRA cannot guarantee it, but you can borrow it. You cannot. The rate is a little higher. So typically, the rate, instead of it being, let's say, 6-7%, it's going to be closer to 8 to 10%. But again, now you can leverage that money, and you just need to make more than the 10% where you put those funds. So, anyways, great question, and yes, you can do it. You can't take them. By the way, also, if your IRA owns an asset and you get a non-recourse loan, that money you cannot cash out to yourself personally. That money you can borrow goes into your IRA, and then your IRA can go buy another asset. You can scale it that way, which is not a bad way. Now your IRA has two assets that are appreciating in value with equity.
Yes, that's where I get excited. And do you mind if I take everyone through a little quick process real quick? Because I think this will be important for everyone because it's really leaning into what you're talking about. So if you don't
Cool.
mind, I wanted to take like 2 minutes to walk
yeah.
So Greg has said this several times so far while we've been on this training, and I fully agree with it, by the way. Um, all these questions are around decisions you have to make personally, not Greg and not me. So they're very personal. Greg's suggestion or my suggestion does not mean those are the suggestions you should be taking, not because they may not be quote unquote right. It's because you have to make the decision that is right for you and your family. Period. End of story. Right. And so I want to help you guys understand my philosophy on life. And then I want you guys to put this into practice for yourself if you can. There's 5 principles to success, a successful life, not successfully getting rich, not owning the biggest business, a successful life. And the first principle that I have found after 20 years of entrepreneurship, and I've posed these 5 in front of every successful person from billionaires to whatever. They all essentially agree and they have different semantics. But the first part, the first principle is you have to decide what you want. That is the very first part. And part of deciding what you want is who do you need to be to achieve it? So, principle 1 is decide what you want, not what Greg wants, not what Justin wants. Decide what you want and who do you need to be. So, in the conversation of real estate, do you need to be a little bit more risky, a little bit more conservative? Who do you need to be to achieve the thing what you want? That don't underestimate the value of deciding what you want. Don't say, "Oh, I want to be this." Like write it out, think about it, go sit in your backyard, decide what you really want in your life. Because for some of you sitting here, you're like, I want my home paid off. I want little to no debt. I don't want to worry about finances ever. Then awesome. And I love you and appreciate you. And then make that decision. And part number 2, the principle number 2 is commit to it, right? Don't be wavering. Oh, hey, oh. Don't be wavering on what you want, right? Like, I don't my personality like is just not that as the example. My personality isn't like I want no debt, I just want a simple life. Like I'm a lot more like go 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 personality. That's not for everybody, right? I take big swings at the bat. I also will take my singles, right? I'm happy with singles, right? So number 3, so you got to commit to what you want. And that's why the first part is you got to really understand what the hell you want. Greg wants this, I want this, doesn't matter. It's up to you. It's very subjective. Okay. Number 2 is commit to the thing you want. Number 3 is you need to live that. You need to take action in that direction or potentially inaction, I should say, right? So if you are like completely risk adverse, if you are all about safety, if you want zero debt, if you want your home, like then live that. Take the actions required to achieve that. Okay? Which means don't have a bunch of credit cards and don't lend money and don't like all these different things. Do be risk adverse. Don't try to be otherwise. If you're like me and you're willing to be riskier, then you need to take those actions, but do it safely, right? Number 4 is a little bit apropos, depending upon who you are, but you're going to be uncomfortable, right? Is if you're going to have a little bit of risk, then it's going to be uncomfortable. It's a little uncomfortable to take risk. If you are going to be very kind of like no risk, no whatever, then you're going to be uncomfortable in the respects of you may not be able to have the big life and take 4 or 6 big vacations every week. That's okay. But just don't want that other side, right? That's why number 1 is so important, right? You need to decide what you want. And the 5th one, if you are living a life that does take risks or making some moves or whatever, this is what I think is the most important one, is you need to give yourself the runway I talked about. That runway is don't have any time expectations on whatever result it is. So if you're sitting there and you're like, Justin, I want to be a little bit more like Greg and have my home paid off and have no debt on my cars and have no real credit card debt, and I want to live more that, well, then take the action, live uncomfortably, right? Don't buy things, right? Live uncomfortably and get there. But it might take a little while. Be okay with that. Don't say I'm going to pay off all debt by the end of May. Like, don't do that. Simultaneously, don't go for the big grand slam home run by the end of May, right? Give yourself the runway that it's going to take to get the result that you want. Either side of these coins, the safe, secure, or the little riskier going for it, there's no wrong. None of it is wrong. They're both right. That is why number 1 is so important. It is subjective to you, your family, and what's most important to your family. So I just wanted to give you guys a little bit of that exercise because we're kind of looking at both sides of the coin. It's irrelevant. It's the coin, the side that you want to choose. That's right for you and your family.
Thank you.
That's a
That's good.
great way to end. I think I wanted to bring up that we have a lot of great guests, just like Justin, lined up in the next 3 or 4 webinars. It's super important that we get other people's perspectives, and we don't always talk about the same thing. SDRAs. It was great to have you on our webinar, Justin. Thank you so much for everything that you did.
Thank you, everybody. Have a great day.
Thank you, guys.
Bye, everyone. Thank you, Justin.
Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.